Most traders think they're getting shaken out by volatility, but Wyckoff revealed the uncomfortable truth. Smart money isn't reacting to the market. Smart money is hunting you. Picture this: price grinds upward slowly, encouraging late buyers to jump in, then suddenly snaps downward with a violent wick that slices through your stop loss like a razor. You panic, you exit, and moments later the market rockets back in your original direction without you. That isn't an accident. It's a stop raid, a deliberate campaign where composite operators push price just far enough to trigger emotional stops set by retail traders clustered in obvious zones. Wyckoff taught that these sudden dips aren't random chaos, they're engineered liquidity grabs designed to shake you out so smart money can accumulate at a discount before launching the true move. In other words, your fear becomes their fuel, and unless you understand the game, you become the target every single time. Ladies and gentlemen, today we're stepping behind the curtain of the financial markets into a world Richard Wyckoff devoted his life to exposing, a world where price doesn't move randomly and losses don't happen by accident. Instead, every sharp wick, every sudden dip, and every painful stop out is part of a carefully crafted campaign by smart money. While most traders blame market noise, Wyckoff understood the truth. Your emotional reactions are the very liquidity that smart money feeds on. And unless you learn how stop hunts are engineered, you will remain the hunted instead of the hunter. So today, I'm going to show you exactly how the composite operator manipulates fear, how your stop loss becomes a target, and how you can finally trade on the right side of the campaign. Armed, prepared, and no longer blind to the traps designed to wipe you out. In Richard Wyckoff's methodology, price movement is never random. It is always the result of purposeful actions taken by the composite operators as CEO. One of the most misunderstood yet powerful concepts tied to smart money behavior is the existence of stop-loss liquidity pools. These are zones on the chart where large clusters of retail stop orders accumulate, creating a concentrated pocket of liquidity that smart money can exploit with precision. Traders often place stops at the same predictable areas, below swing lows, above swing highs, under obvious support, or just beyond a trend line. While retail traders view these locations as safe, the composite operator sees them as opportunity, easy liquidity waiting to be harvested. A stop-loss liquidity pool forms because thousands of traders interpret the same chart structure the same way. For example, imagine price trending upward and forming a clean series of higher lows. Retail traders place stops just below those lows, thinking the trend will hold. Over time, a cluster of stops builds beneath each pivot. Wyckoff understood that smart money rarely chases price. Instead, it accumulates positions by using the liquidity provided by uninformed traders. To accumulate efficiently, the CO needs liquidity, large sell orders they can buy into without moving price drastically. Where can they find these sell orders? In the stop-loss pool sitting below a swing low. So before smart money launches the next markup phase, they often drive price downward, pierce the support, trigger those clustered stops, and absorb the resulting sell-side orders at a discount. This mechanism creates the illusion of a breakdown to retail traders, provoking panic and emotional exits. But Wyckoff taught that these moves are not breakdowns. They are spring actions, intentional liquidity grabs that shake out weak hands and absorb their supply. After raiding the stop-loss pool, price quickly reverses upward, leaving traders stunned and frustrated. They believed they were faked out, but in reality, they placed their stops in the most predictable location, making themselves an easy target for the CO's accumulation campaign. Stop-loss liquidity pools also form in distribution phases where the CO builds large short positions. In that scenario, the liquidity pool forms above resistance, whereby stops from breakout traders are clustered. The CO pushes price upward into those stops, absorbs the buy orders to fill their shorts, and then rapidly reverses price downward, trapping breakout chasers at the top. Wyckoff warned traders to recognize these patterns. Smart money creates the illusion of breakout strength only to use the liquidity for their own objectives. Understanding stop-loss liquidity pools shifts your trading mindset from reactive to strategic. Instead of placing stops in obvious, emotionally comfortable areas, you learn to think like the composite operator. You start identifying where liquidity is stacked, which side of the structure is vulnerable, and what the CO must do next to gather the fuel needed for the next true move. Wyckoff emphasized that once you understand how and why stop-loss raids occur, you stop being the hunted, and you begin trading with the same logic as smart money itself. Richard Wyckoff's greatest contribution to market education was the revelation that behind all price movement lies a single, intelligent force he referred to as the composite operators as CO. This wasn't a literal person. It was the combined influence of institutions, banks, funds, and professional operators acting with unified logic. While retail traders react emotionally to price fluctuations, the composite operator strategically creates those fluctuations to achieve one purpose: accumulate or distribute stock at favorable prices without revealing their true intentions. This is the essence of market manipulation. Not illegal activity, but professional campaigns orchestrated with precision. To the untrained eye, the CO's actions look like chaos, sharp reversals, unexpected wicks, violent spikes, fake breakouts, and sudden breakdowns. But Wyckoff taught that every move has a motive. The composite operator manipulates price not to confuse traders, but to extract liquidity, gather positions, and remove competition. For example, when smart money wants to accumulate large, long positions, they know they cannot simply buy aggressively. Doing so would push the market upward too quickly and reveal their hand. Instead, they manipulate price downward, generating fear and convincing retail traders that the market is weak. As traders panic and sell, the CO quietly absorbs their supply. This process repeats until enough inventory has been collected. One of the most common forms of manipulation is the engineered shakeout, where the CO intentionally drives price below support to trigger stop losses. This creates a flood of sell orders that smart money can buy at discounted prices. Once they're filled, the market snaps back in the opposite direction, leaving retail traders confused and emotionally damaged. Wyckoff highlighted these actions as deliberate tactics within the accumulation phase, designed to transfer stock from weak hands to strong hands. During distribution, the manipulation reverses. The composite operator uses false rallies, bull traps, and liquidity grabs above resistance to attract enthusiastic buyers. As retail traders buy the breakout, the CO sells into their excitement, unloading massive positions at premium prices. Retail sees momentum, but the CO sees an opportunity to offload inventory without causing a collapse. Once distribution is complete, price rapidly reverses downward, trapping late buyers at the top. Another layer of manipulation involves time. The CO often drags out accumulation or distribution phases longer than retail traders expect. This creates boredom, frustration, and impatience. Traders either enter too early, exit too early, or abandon their analysis. The CO thrives on this emotional imbalance. Wyckoff believed that the market is a never-ending psychological war where smart money uses time as a weapon to thin out weak participants. The brilliance of the composite operator lies in its ability to disguise intent. Accumulation looks like weakness, distribution looks like strength. By understanding how the CO manipulates price, volume, and trader emotions, you transition from blindly reacting to reading the campaign. Wyckoff emphasized that once you can interpret CO behavior, the market stops being a mystery and becomes a structured narrative, one that smart money writes and one you must learn to read. In Wyckoff's framework, the greatest weakness of the average trader isn't lack of strategy, It's the inability to control emotions under pressure. Smart money understands this better than anyone. The composite operator has no interest in your indicators, no concern for your chart patterns, and no sympathy for your fear. But what the CO does care about is your emotional stop-loss placement, because emotional stops are predictable, clustered, and easy to exploit. Thus, emotional stop triggering becomes one of the CO's most powerful tools for creating liquidity and shaking weak hands out of the market. An emotional stop is not placed logically. It's placed for psychological comfort. Retail traders often choose levels based on where they hope the market won't go, just below a recent swing low, just above a resistance area, or at the exact level where they fear losing too much money. These stops often align across thousands of traders, creating a high-density liquidity zone. The composite operator sees this clustering as a roadmap, a guide revealing where the most vulnerable pockets of liquidity are hiding. Wyckoff taught that smart money does not simply take the opposite side of your trade. They engineer price movements to force you into fulfilling their liquidity needs. Emotional stops are the easiest to manipulate because they are placed at the most obvious and emotionally driven points. When retail traders enter a position based on excitement or fear of missing out, their stops are usually tight and poorly located. They are more concerned with feeling safe than understanding market structure. This emotional vulnerability makes them the perfect target. Imagine a scenario where the market is trending upward. Retail traders jump in late, driven by urgency and fear of being left behind. They place their stops just below the last minor pullback. Smart money sees the growing pool of stops and knows they need liquidity to add to their positions. So they momentarily push price downward, dipping just far enough to trigger all those stops. As retail sells, smart money absorbs their positions at discount prices. Once the liquidity has been harvested, the market resumes its upward movement, leaving stopped-out traders behind, frustrated and confused. This is not randomness, it is a calculated stop-triggering algorithm used by the market's most informed participants. In distribution phases, emotional stop triggering is reversed. Retail traders become overly confident as price rises. They place buy stops above resistance, believing breakouts will continue. The CO pushes price just above the level, triggers the buy stops, sells into the forced liquidity, and then aggressively reverses the market downward. These buyers are trapped at the top, victims of emotional trading fueled by greed. Wyckoff emphasized that emotional stop triggering is not just a technical phenomenon, it is psychological warfare. The CO plays on fear, greed, impatience, and insecurity. The only antidote is to think like smart money, place stops logically based on structure and context, not comfort or emotion. When you stop reacting emotionally, you stop becoming the liquidity that smart money hunts. In Wyckoff's market philosophy, price does not simply reverse because it feels like it's too high, or because a random indicator flashes a signal. True reversals occur in precise locations engineered by the composite operator, zones where liquidity becomes imbalanced, supply is exhausted or absorbed, and smart money steps in with intention. These areas, known as liquidity gap reversal zones, are regions where the CO creates or exploits thin pockets of liquidity to fuel major turning points in the market. A liquidity gap forms when price moves too quickly through a level, leaving behind weak structural support. This fast movement typically reflects a one-sided imbalance, either aggressive buying or aggressive selling. To the untrained trader, these gaps look like strength or weakness. But Wyckoff taught that these rapid moves often hide a far deeper truth. Smart money is maneuvering price into zones where retail traders become emotionally reactive and liquidity becomes trapped. For example, imagine the market aggressively rallies upward on high volume, slicing through multiple price levels without forming proper support. Retail traders see strength and rush in, driven by fear of missing out. They place buy stops above obvious highs and enter positions at the worst possible prices. But hidden beneath this sharp rally is a liquidity gap, a zone where price moved so quickly that no meaningful support exists. When the composite operator decides to reverse the market, they push price back into this gap. Retail buyers panic because they have no structural protection. Their stops get triggered instantly, providing smart money with the liquidity needed to unload or reverse positions. This is why Wyckoff warned traders that the most dramatic moves often precede the most violent reversals. Liquidity gap reversal zones act as magnets. When price revisits them, volatility spikes, volume swells, emotional trading intensifies. This is the CO's ideal environment for accumulation or distribution. If smart money wants to accumulate, they drive price into a previous gap where retail sell stops are clustered. As traders exit in fear, smart money quietly buys. When they want to distribute, they push price into an upper gap filled with buy stops, allowing the CO to sell into the forced liquidity. What makes these zones particularly powerful is their psychological impact. Traders remember these areas. A rapid breakdown that previously caused panic creates emotional scars. When price returns to that zone, fear resurfaces. Traders hesitate, tighten stops, or misread the structure. Wyckoff emphasized that markets are driven by human behavior, and liquidity gaps amplify that behavior by reminding traders of past pain. Over time, these zones become reversal hotspots, locations where smart money has the greatest advantage. They know where traders are trapped, they know where fear peaks, and they know where liquidity is most abundant. So while retail traders see chaos, the composite operator sees opportunity. Understanding liquidity gap reversal zones shifts your trading perspective from guessing where markets might turn to identifying where reversals are designed to occur. Once you learn to read these structural imbalances through Wyckoff's lens, you begin to anticipate the very reversals that once caught you off guard. You stop chasing momentum, and you start following the footprints of smart money. Among Richard Wyckoff's most powerful insights into market behavior is the concept of the smart money shakeout mechanism, a deliberate campaign engineered by the composite operators as CEO to flush out weak holders, absorb liquidity, and position themselves for explosive moves in the opposite direction. While retail traders perceive shakeouts as unexpected volatility or the market attacking their trades, Wyckoff understood these events as highly intentional phases embedded into accumulation or distribution cycles. A shakeout is not simply a pullback. It is a psychological and structural trap designed to force traders into emotional decisions. In accumulation, the CO wants to buy large amounts of stock without pushing price upward prematurely. But there is a problem. Retail traders often enter early and place stops at predictable levels beneath support. If smart money tries to buy normally, they would drive price up and make accumulation expensive. The solution: engineer a sudden, violent move downward, one that creates fear, triggers clustered stops, and forces retailers to exit at the worst possible moment. This downward spike is the shakeout. It sweeps liquidity from the markets in seconds. Retail traders panic because the move feels catastrophic. They believe the trend has reversed and rush to exit. Meanwhile, the composite operator is on the other side of those stop orders, quietly absorbing massive amounts of supply at discounted prices. Once enough weak hands have been eliminated and the CO has filled their inventory, the market rapidly reverses upward. The move is so fast that most traders cannot re-enter. They watch helplessly as price rallies without them. Trapped in regret and confusion, Wyckoff emphasized that a successful shakeout leaves behind clear footprints. The wide price spread during the drop, high volume at the bottom indicating massive absorption, A instant sharp reversal showing smart money entry E failure to follow through downward confirming lack of real selling pressure. These clues reveal the CO's hidden hand. In distribution, the shakeout mechanism is inverted and becomes an upthrust. Here, the CO wants to sell their large long positions, but retail traders are overly bullish and eager to break out trade. Smart money drives price sharply above resistance, triggering buy stops and inviting FOMO-driven entries from retail participants. Once sufficient liquidity has been harvested, the CO unloads their positions at premium prices and then forcefully reverses the market downward. Late buyers become trapped at the top, their emotional optimism turned into instant losses. What makes the shakeout mechanism devastating is its psychological precision. It attacks the two strongest emotions in trading, fear and greed. Retail traders respond to visual cues, breakdowns and breakouts, while smart money creates those cues to exploit emotional impulses. The shakeout is designed not just to remove traders from the market, but to condition them with doubt, hesitation, and trauma that keeps them from re-entering. Wyckoff taught that recognizing a shakeout in real time transforms your trading. Instead of panicking, you begin to see the intentional patterns. Smart money clears the field before making the real move. When you understand this mechanism, you stop being the shaken and start trading in harmony with the silent operator who orchestrates each phase of the campaign. In the end, Wyckoff's teachings reveal a truth most traders never realize: the market is not your enemy, your emotions are. Smart money isn't hunting you, it's hunting the fear, greed, hesitation, and impatience that shape your decisions. Stop-loss liquidity pools, composite operator manipulation, emotional stop-triggering liquidity gap reversal zones, and the smart money shakeout mechanism are not random market events. They are carefully engineered strategies designed to transfer wealth from weak hands to strong hands. When you learn to see these footprints, not as chaos, but as the deliberate campaigns of the composite operator, you step out of the crowd and into clarity. You stop reacting to traps and begin anticipating them. You stop being targeted and start thinking like the architects of the market themselves. And that shift, more than any indicator or pattern, is what transforms you from a confused trader into a confident operator in harmony with smart money's true intentions.